please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. The struggle in the market is actually well and truly on. The weak hands really stand out. They're largely from the financial universe. We've been telling you that Bajaj Finance should be pulled up, State Bank of India, even pull up something like an Axis Bank at this point, where the cut is almost 1% now. Financials really out of favor. So these are some of the bigger stocks which are sulking around. The rupee move obviously is going to hit importers as well. So HPCL would be a case in point. High crude prices, rupee at 71. Not a great headline if you are HPCL. So that's another stock which has fallen to the lows of the day. Let's now move on and track another story here. Auto dealerships in Mumbai are on the radar of the GST Commissioner. Now, sources are telling us that top auto dealerships have been sent notices. What is the issue here? Let's find out. We have Utkarsh Chaturvedi joining in with the details. Why notices and what's with the GST issue, Utkarsh?
So, Surabhi, what we are picking up is that most of the car dealerships in Mumbai are on the list of GST Commissionerate, and the notices have been sent because the GST CBIC wing of Mumbai have found irregularities in the GST filing from many top dealerships of the city. Now, department has also sent notices to dealerships stating them to clear their dues or face action. Now, what our sources tell us is that Commission Office believes that there have been cases of tax evasion by the car dealerships in the city. Sources believe that the cases of tax evasion happened in the case of miscellaneous expenses where GST was charged from the customer but not filed by the dealership. So dealers of, in fact, top brands like Hero, Maruti, Jeep, Toyota, BMW have been sent these notices. Sources also inform us that many dealers have contacted the GST officials after they have received the notice and have assured payments to be settled. Sources also indicate that some players have already went ahead and cleared their dues. In fact, we tried speaking to some of the biggest dealers and they have confirmed receiving the notices from the GST office, but they said that they are working with the GST office to clear their dues as soon as possible.
Okay, Utkarsh, thanks very much. So that's the back and forth between companies and the tax department. We will keep you posted on that one. 26 points lower on the Nifty. Ashwini is with us as always at the top of 11:30. Ashwini, morning. How do you read this weakness which is starting to creep in more prominently now?
See, you're 20 points lower on Nifty. I don't think weakness is creeping in. The way I would look at this is that given the hell that's breaking loose on the currency and crude and everything, we're doing fairly well. And people who are getting short on the market will finally get trapped the day crude falls $2 and currency stops falling. So my sense is that, whenever you get into this zone of 27,900, 28,000, you should be trying to buy into Bank Nifty as well as Nifty around 11,600, 650, because like we saw in the morning, when the turnaround happens, it will be fairly swift. Because till now, if we had to fall, we would have fallen. The currency is weakened enough. Crude has gone up. Markets don't give you a second invite to get out at a marginal profit or a loss. This just means it's a strong market and just waiting for things to turn around a bit. Having said that, for the moment, immediate, rupee is weak and hence all rupee sensitive should do well. So HCL Tech is a buy with a stop of 1,045, target of 1,085. USL is a sell with a stop of 641, target of 625. And Larsen is a buy with a stop of 1,350, target of 1,385.
Ashwini, just very quickly on Yes Bank, what are the levels you're watching for now? 340 as we speak?
See, I don't know how this is finally going to play out, but what I think is that we've already reached the 200-day moving average. Now, either the bank is about to close down or some wire media will come out. From 400 down to 340, I don't think there is any incremental big downside. This is where, people should start piling up positions as an investment and add on as the bank comes out of it, given that overall banking is not feeling so good. I think this extra issue has just added to some pressure. But my sense is you should buy it here and finally look for levels higher than 400.
This Friday, we're looking at slight weakness in the market, a bit of a pause. That's what the bulls seem to be taking on. But we're at that level of 11,650. So let's see if that holds or not. Amit Dalal, ED at Tata Investment Corporation, is now joining in. Amit, good to have you on the show. Thanks for joining in. We're in interesting times. The market has rallied quite a bit. And we're seeing some participation and interest come back in the mid-caps as well. But then there are these macro headlines which don't always add up right. Crude oil prices, the rupee. How would you sum up where we stand today in the market and whether you think bulls have a bigger and better case from here on?
So technically, I think the market is full of confidence. Allocations to equities remains high, domestically at least. In India, there is more and more confidence that you have to perhaps remain invested in equities over the long term, and therefore you don't see any fall in SIPs. And also the insurance companies are becoming larger, and therefore their allocations to equities remains high. Globally, I think there are mixed views and mixed trends which are coming from various parts. Interest rates are rising, and therefore there are cues that perhaps one should reduce allocations, but still equity markets in the United States keep ruling on an upward trend. So I think the global markets are perhaps more mixed in their approach to equity allocations. But in India, I think equity allocations remain on a positive note.
Amit, and this is happening at a time when FIIs continue to be sellers, right? So how does that... you look at, and people have been saying that money is coming from locals, but that tap is also thinning out a little bit, isn't it? I mean, last month, equity schemes got about 10,000 crores. At the peak, it was almost about 20,000 crores or so. So what do you reckon happens in the immediate term? Do we continue to move higher? Or do you think the next thing we see before any substantial move on the upside is actually a correction?
If in terms of the money flow, when it becomes less, what you really see is a narrower market. So if you've seen in the last 4 months since April, there has been a very narrow outperformance of stocks within the indices and a larger secular consolidation taking place, and that's why the mid caps and small caps had gone down, and of course there were some regulatory issues which led to those sell-offs also. I do think that the markets are very expensively priced right now, and therefore correction should come forth, given both the fact that we are going into an election season in the next quarter, and perhaps you will see 2 rate hikes coming from the United States by December of this year, as promised by the Fed. Given that background and the fact that we have a market which is almost 25 times earnings and a PEG of 1.5, I do think we are in a higher risk zone than one would like to be.
Amit, the biggest talking point right now on the street is whether we're really turning the page with respect to corporate banks, biggest lenders like ICICI, SBI. Now, here's the thing. These stocks have moved up around 30% from their lows. What do you think is being baked in right now? What sort of a recovery are we talking about? And would you say that this current rally has more sort of momentum? Is this the real deal?
So again, you know, on the table we have to differentiate between the private sector banks and the public sector banks, and therefore what is happening in HDFC Bank is perhaps very different in character than what's happening in State Bank of India. HDFC Bank continues its momentum of increasing its book without having the pain of NPAs, and it continues to do both individual lending and corporate lending, and individual lending part of its portfolio is growing equally as it did in the past. And so its mix is giving it a higher ROE than perhaps the public sector banks. Now, the public sector banks have gone up 30% in the case of State Bank, mainly because there is a statement made by the banks that we are reaching perhaps the peak of the NPS deterioration cycle. And it seems evident that we are. The recognitions have been very strong and regulatorily pushed to a level where I think the books now look fairly well recognized in terms of the NPAs. The economy is improving on the ground. The markets and the demand for products have now got stabilized after GST getting into the system in a very, very seamless manner. So I think you have a case to be made that these banks will not see higher contingencies in the next couple of quarters. Contingency provisions, sorry.
Okay. Coming to other stuff that you're saying maybe worse is behind for PSU banks, not necessarily that you yourself are buying those stocks, but the other sectors which you are actually positive on is metals and IT. Amit, if you could just explain the thesis behind those two. And in metals, specifically steel.
So here are the things. When I say that we remain positive, it's because we are invested in these sectors, not necessarily we are doing anything incremental in those companies. I think in terms of IT, they have had beneficiaries. They have, of two things. One is, of course, the currency has gone completely in their favor. But the second is, if you take a company like TCS or even now Infosys, they're talking of reorganizing a skill set of such a huge population of people working for them in a manner in which makes them competitive in the global IT space. And it's, the proof of the pudding is available every quarter that we are seeing the results. So that is not going to be ignored by the market, and that is something that's going to always give you market cap appreciation as time goes. And to be honest, I mean, the returns that have come in many of the IT companies in the last 1 year have been just phenomenal. Even the mid-cap IT. Take L&T, it floated two companies one after the other, and those share prices are almost 60 to 80% higher than what their IPO prices were when they were listed. And that's very rewarding to the shareholders of those companies. And very, very creditable to the management of Larsen Toubro and its group. I do believe that that is both a market-related situation and a core to the companies themselves.
And steel, Amit, what do you see there? Because many believe that prices are steel prices continue to strengthen in a.
So that's of course
in a off season. But how far will these sustain? Will these price hikes and prices at these levels sustain?
So it's a China-driven story, right? We all know this in terms of graphite or in terms of steel. It's a China-driven story where Chinese capacities have been closed because of pollution problems or because they are reorganizing. And those capacities do not have any substitution taking place in China. So you don't have China exporting anymore, and therefore the global markets of steel remain strong. And that does not seem to be any let-up in that argument, or there does not seem to be any reason to believe that that's going to change in the next quarter or two. So I think steel manufacturers in India will continue to benefit. Also, there has been a reorganization of capacities in India in terms of the NCLT. So there has going to be some benefits coming from higher production of steel in India too.
You've got the market, which is down about 17, 18 odd points or so. It's not really going anywhere. We've got a very special guest now joining us. Rashesh Shah is Chairman and CEO of the Edelweiss Group. And he's joining us from the sidelines of the CFA Society India's third Wealth Management Conference. Mr. Shah, thanks very much. Great to have you with us here. You know, someone half-jokingly once told me that... only half-jokingly once told me that Edelweiss is building out to be the Goldman Sachs of India. And you know, one of the businesses which is really powering for you is the wealth management business. You know, I was reading a Credit Suisse note there talking about how, you know, how well you're sort of scaling up that business. Talk to us a little bit about the size of the industry, the wealth management industry. How do you see that growing from here? Margins that one makes, competition. Just give us the lowdown. I mean, you're at this wealth management conference to begin with.
Yeah, I think India is growing fairly well. All parts of financial services, credit, asset management, wealth management, all of them are showing a lot of growth. But as you correctly said, one aspect that is growing fairly fast is wealth management. And a large part of that is because household wealth in India is now rapidly growing. There's a lot of household wealth out here, and a lot of that is growing. And India is now becoming a capital surplus country. And as we are becoming capital surplus, it is giving us a huge amount of opportunity to invest money. And households are starting to, earlier, 10, 15 years ago, most of the household savings went into gold or real estate, property, land, or into bank deposits. In the last 10, 15 years now, households are saying, can I invest it slightly more efficiently? Can I diversify my investments? Can I invest in mutual funds, equity, insurance products, alternative funds, structured products? And I think this entire trend of what we call the financialization of household savings and the entire advice and intermediation that it requires is creating a big opportunity for the wealth management products and services in this country.
Morning, sir. I completely take that point. Yes, I think demonetization really shifted the course, altered the course in a big manner in terms of how we deal with money. But the question is this, from an asset management company's point of view, what about the profitability of this business? Because the regulator has been constantly sort of cracking down and expense ratios have been falling. So over the next, let's say, 2 to 3 years, what should we expect in terms of the profitability from the wealth management and AMC business largely?
I think overall both asset management and wealth management businesses have become reasonably profitable. I think most of the companies make about 20 basis points of their assets under management as profit. And we see that as consistently because, as you correctly said, yields will come down, your fees and commissions will come down, but your cost will also get more and more efficient because as you get scale, you will get economies of scale. Technology is driving a lot of reduction in cost in that also. So overall, we think the margins, even if you look at globally also, I think our 20 basis point profit after tax margin on assets that you manage is easily achievable, and most of the Indian players will be around that. Some will be at slightly higher than that, some will be slightly lower than that. But what is more important is, though your yields will come down, your scale is going up very fast. This industry is growing, the AUMs are growing at 25% per annum, and that kind of a growth is going to give a lot of opportunity for people to improve their profitability and keep on investing more in technology as you go towards that. So I think the growth rate is going to be a key ingredient to watch, not just the yield into these businesses.
Mr. Shah, we have to take a break, but briefly, 20 basis points PAT as a percentage of AUM, it is, I thought private wealth management is actually a lot more profitable than mutual fund sort of profit margins, or is it fairly similar?
No, it is actually fairly similar. If you look at it, most of the players average between 10 to 15 basis point to 25, 30 basis point.
Okay.
And average for the industry is still at 20. As you know, we have grown our wealth management business fairly rapidly. We are now the top 3 wealth managers in India. And we look at it across the board with all the other wealth managers, and we see this trend as an average for the industry.
We are in conversation with Mr. Rashesh Shah of Edelweiss. Sir, one of your big businesses, the ARC business, is obviously where the headlines are coming from these days. The numbers that I saw, I think the book size roughly is around 43,000, 44,000 crores perhaps. Just want to understand how you're viewing this fire sale which is underway in the NCLT right now. Your thoughts on the sort of power assets. We believe, maybe 30 accounts could be pushed in unless there's some quick resolution. How would you view this, and what are the kind of haircuts that would perhaps make someone like you interested as a buyer?
As you may have seen, our ARC is very active, and we have been working with a lot of banks on a lot of these power assets. And I don't think there is one industry-wide norm, but if you're seeing most of the assets are going at between 2 to 3 crores per megawatt. A lot of the power thermal assets are being acquired by people in NCLT and even outside of NCLT at about 2 to 3 crores per megawatt. But if you look at all the power assets, there are usually 3 categories of assets. There is one category of assets which are very hard to make them viable. These are, plant based on gas or some other, input, which is very expensive now. So those, I think, will not find a lot of interest from a lot of players because those are theoretically unviable. The second category of assets are the ones which are viable, which are operating also, but have a lot of debt. So if you take a haircut on that, and instead of the current maybe outstanding debt, which can be 7 to 8 crores per megawatt, if you can bring it down to 2 to 3 crore per megawatt, they become very viable. Those are the ones a lot of strategic buyers, a lot of funds like ours are interested to buy. And if the pricing is right, there could be a lot of growth and revival opportunity in that. And the third category that also we have been interested in are power plants which are viable, but are currently the project is not completed. It's 80-90% completed, and it has become an NPA. It needs some fresh money. It needs some active involvement to complete the project and bring them on stream, at which point they will be viable. So I think it's very asset to asset based, but there are about, I would say, 70-75% of the assets fall in the viable category, whether viable after completing the project or viable with a haircut in that category. Only about 20-25% of the projects are theoretically, technically unviable because of the high input cost also.
Mr. Shah, you have a bird's eye view on what is coming up at NCLT, what may come up at NCLT. You said Edelweiss is working with banks very closely on a variety of these assets. Could you talk to us a little bit about what should we expect in terms of haircuts for financial institutions, lenders in the second list? Maybe we'll have another list after that with a new threshold which RBI may prescribe. Should the haircuts that banks will take be similar to what we've seen so far from companies that have gone to the NCLT in the first list?
See, again, there is no one rule of thumb. Even in the first list, you have seen there have been steel plants that have gone at 80 cents to the outstanding, amount. There have been ones which have gone at 30% of the outstanding amount. So it's very asset to asset specific. I think the general rule that RBI has that when a case is referred to NCLT, banks have to provide for 50% of the outstanding amount as the provisioning. I think that is adequate. I think on an average, across all of that, a 50% provisioning will be more than adequate for the haircuts that bank would expect to take. But individual cases might be different. There might be some cases where there might be 80% haircut, and there might be some cases where there might not be more than 10 to 20% haircut. So I think overall RBI has been very prudent in recommending a 50% provisioning for NCLT assets. And I think that not just for the power assets, for all the assets should be the norm.
So, very short on time, just going to quickly squeeze in this last question. That second bucket of stress power loans that you spoke of, where, buyers like you would have some interest, where there is a scope to turn things around, what kind of a haircut would be reasonable? Well, you said if the price is right, because right now the market is baking in some very strong recovery numbers for a lot of these corporate lenders, for banks like SBI, ICICI, lenders to these assets. So I just want to get the sense whether we are in touch with reality here in terms of the haircuts that buyers and sellers might agree on.
As I said, if you see a couple of power plants that have also got done, a lot of the cases are going at 2 to 3 crore a megawatt. So rather than say haircut, because if your carrying cost is say 5 crore a megawatt, then a 3 crore is only a 40% haircut. But if your carrying cost is 8 crores, then a 2 crore per megawatt is a 75% haircut. So it's very hard to give a clear percentage. As I said, average for the portfolio of 50% haircut, which is what RBI is expecting and asking banks to provide for that, is very much a good estimate on that for the portfolio as a whole. So I don't think there'll be a root shock for the banks where what they are providing they will be inadequate. I think what they are providing will be more than adequate to cover the actual haircuts that they will take. But we should average look at the rule of thumb of 2 to 3 crore per megawatt for these power assets.
Mr. Shah, thank you very much. Appreciate you joining in. It's a great conversation as always. Thanks for your time here today on CNBC TV18.